day friends. In the subject of fundamental of investment, in this lecture I will be talking of valuation of equity shares. In the valuation of equity shares, in my previous lectures I have talked about that how valuation of equity shares differ from the valuation of bonds, that is fixed income securities. And there are different models of valuation of equity shares, right? And in my previous lectures I focused on dividend discount model or dividend capitalization model, that is the valuation is being based on the dividend income or dividend earnings of a shareholder. In this lecture I will be talking of valuation based on earnings, because as we know that many companies, especially which are growing companies, they do not give whatever they earn in form of dividend. Part of it they distribute in form of dividend. We have call it payout ratio, right? That supposing a company pays 30% of its earning, so we call it payout ratio is 30%. And rest is called retention ratio, right? That is whatever it earns, it retains 70%. And this retained money, that is earning, is being used for the expansion of the company, for the growth of the company. So friends, let's be very clear that most of the growing company, rather I would say most companies, do not give, practically do not give whatever they earn, right? Whatever the earning per share is, that part of it is being distributed to the shareholders and part of it is being retained for future growth and expansion purpose. Even sometimes some of the companies do not give dividend at all, and whatever they earn they keep with itself and they reinvest this money for the growth of the company, and they are able to generate more income, more earning than a ordinary shareholder can earn. Means although it is a different matter, it is a subject of debate that what others can earn, but company under its presumption, under its assumption that we can grow this money at a faster rate as compared to a ordinary man who will, if it is being given in form of dividend, right? So anyway, the idea is that the company keeps the to keep the thing simple, we'll say that company retains the earning, and sometime the fully, sometime partially, right? So this is called valuation based on earnings. So there are number of firms who have considerable growth opportunities and require funds for the new ventures. So these firms may reinvest all their earnings to earn. When I am saying all their, means it may be all or it may be partially their earnings to earn higher return in future. Hence, dividend discount model, which we discussed in my previous lectures, right, which I talked about in my previous lectures. Hence, dividend discount models cannot be applied here, and hence the value of the equity share may be estimated on the base of earnings of the firm. So when I am saying approaches based on earning, by and large we talked about three different models. One is known as Walters model, other is known as price earning ratio or earning multiplier approach, and third is called capital assets pricing model, right? So capital assets pricing model is also a very popular model of valuing the shares on the base of earnings. Let's discuss one by one, right? I said first is Walters model. Let's discuss what Walters talks about, that how the valuation of share is being done. So this model assumes that the value of equity share is the sum total of present value of infinite stream of dividends, right? So whatever the income that is generated by the company, part of it is being given it in form of dividend. So what is the present value of dividend? A, and B, present value of infinite stream of capital gains. Capital gain is return from retained earning. As I said in the beginning of my lecture, that the earnings that is being made by the company, partially it is being given in form of dividend, practically also, and partially it is being retained by the company, right? So as per the Walter, there are two things. One is the present value of dividend, which the company will distribute over a period of time, over a period of the life of the company. The other is the present value of the stream of income that will be generated by the company by keeping the money as retained money. Supposing a company earns 10 crore rupees in a particular year. out of this 10 crore rupees, 4 crore, I am presuming that this is the constant, and I am presuming this is constant, year after year the company is earning 10 crore rupees. And, or if I say even the earning rise, every year company keeps 40% as for dividend, that is distribute dividend 40%, that is 4 crore, and 60% it retains with itself, right? And whatever is being retained, suppose in case of 10 crore, 4 crore is being distributed as dividend, X 6 crore rupees is being, retained, which is kept with the company. And on this 6 crore, it earns a percentage of income, right? And it earns say 15%. So what will be the income that will be generated by this retained earning? And what is the present value of this retained earning? So there are two things: present value of the stream of dividend plus the present value of the returns that the company will generate on its retained earning, right? So if you make the sum total of it, that comes to be the price in the current year, right? Price in the current year means P0, which we known as P0. So P0 is equal to D over KE. D is nothing but the dividend. I am presuming that D will remain constant throughout the life of the company. D over KE. KE is your nothing but required rate of return, as I said in my previous lectures also, that KE is the required rate of return. Whenever an investor invests in an equity share, what is the minimum return which the investor expect while investing in that share? That is called KE. Plus, this is the present present value of the dividend income, D over KE, plus there are two parts: present value of the infinite dividend income plus present value of the infinite stream of capital gains, that is return from retained earning. And what is the return of retained earning? What is the formula? R divided by KE multiplied by earnings minus dividend. E is earnings, that is earning per share, right? Or you can say expected EPS, and D is the dividend, right? That is E minus D becomes the retained earning. Suppose a company earns 10 rupees per share, 4 rupees is being distributed as dividend. So dividend payout ratio is called 40%. If I earn 10 rupees, if I distribute 4 rupees, it means my dividend payout ratio is 40%. And rest 6 rupees is my retained earning. So E minus D is your retained earning. Earnings, earning per share minus dividend. Divide by KE, required rate of return. So D is expected dividend per share, E is expected EPS, earning per share, right? And friends, you know what is EPS, earning per share? Total earnings of the company means net profit after tax minus preference dividend divided by number of equity shares. That is, whatever the company earns. See, as you know, for shareholders, it is called residual income. After paying to the creditors, debenture holders, bank loan, all creditors, whatever is left out, whatever net profit is left out, that belongs to the shareholders. And in the shareholders too, you know that there are two types of shareholders: preference shareholders and equity shareholders. So preference shareholders have a prior right as compared to the equity shares. So the net profit after tax minus the preference dividend you pay to the preference shareholder, and then whatever the residual income is left out, that belongs to the equity shareholders. Divide by number of equity shares of the company. That is called earning per share. That is how much profit, how much earnings on each share the company is earning. Supposing a company, the face value of a share is 10 rupees and 4 rupees company is earning on each of the share, that it means EPS is 4 rupees, right? So E is expected EPS, KE is your required rate of return, right? R is equal to rate of return on equity. That is, when a company invests its money, how much return it generates. Suppose my ROI, return on investment, is 20%. It means whatever the money I invest, I earn 20% of it, right? So R is nothing but required rate of return, not required, I would say rate of return on equity shares, right? So this way you can find out the value of the share. That is, once again I am repeating, D over KE it is the value of the dividend income plus R divided by KE into E minus D. E is earning per share minus dividend, right? That is retained earning divided by KE. So, as per the Walter model, this is very important to understand. According to this model, EPS and dividend remain constant. I am presuming to keep the same cycle, Walter presumes that earning per share will remain same and dividend will remain constant. Means on the base of earning per share, suppose earning per share is 10 rupees and dividend is 4 rupees. So, year after year company will give dividend of 4 rupees. And the relationship between R and KE as well as dividend payout ratio determines the share value. So, it means there are three things which are important to find out the share value. One is R. R means rate of return on equity investment or rate of return on investment. KE is the required rate of return of investors, of shareholders, and what is the dividend payout ratio. That will determine the valuation of the share. And a general rule is if R is greater than KE, right? So, share value will be maximum when dividend payout ratio is given. What it means is if company is making a return of, say, let me take an example, say 20%. If whatever is the money that is being retained by the company, if on its investment company earns 20% and K required rate of return of the investor is 15%. So, it means that the company is earning more than what is the required rate of return of investors. And if I am investing in a share, I presume that I will be very happy man if I get a return of 15%, right? But company, if it keeps the money with itself, company is getting a return of 20% on this money, which is not being distributed to me, right? So, it means the company is generating more income than what shareholder can earn. So, that is R is greater than KE. In that case, the share price will be maximum if the company does not pay dividend. Means no dividend is being paid. In that case, as per the Walter model, there are many other things which can be discussed, but here to keep, remain stick to the Walter model, I will say, as per the Walter model, if R is greater than KE, rate of return of the retained earning of the investment is greater than the required rate of return of the investor, then the share price will be maximum if no dividend is being paid. Dividend payout is 0%. Just opposite of it, if R is less than KE, that is the rate of return, let me put it things the reverse way. If whatever the investment company makes, company get a return of 15% on its investment. Means I am presuming whatever the money that is being invested by the equity shareholders, company earns 15% of it. And the required rate of return of the investors is 20%. That I want that my investment should fetch me a minimum income of 20%, right? It means company is earning less than what investors expect. In that case, share price will be maximum if company distributes whatever it earns. That share price will be maximum when dividend payout ratio is 100%. If your earning is 10 rupees, you give all 10 rupees to the shareholders, your payout ratio is 10%. In that case, the share price will be maximum. And third scenario is if R is equal to KE, that is your rate of return on investment by the company is equivalent to required rate of return of investment, then the dividend payout ratio will not affect. Means it is indifferent. Share value will be same irrespective of dividend output ratio. Whether you give more dividend, whether you give less dividend, share price will not be affected if at all the R and KE is equal, right? So, these are the three different scenarios as per the Walter model. Now, let us take an example and try to explain it. The earning per share of PQR Limited, right, is 20 rupees. That is, we are presuming that a company which is known as PQR, it is earning 20 rupees dividend year after year. Not dividend, is earning, is 20 rupees per share. And the required rate of return of the investor is 15%. When an investor invests in the equity share, her required rate of return is 15%. If rate of return of investment is 10%, that is whatever the money company has, when it makes the investment, it earns 10% on it, and payout ratio is 40%. Find out the current value of the share and how it can be maximized. Right? Friends, one thing you note, here R is less than KE. Right? And if you recollect, I took a case when R is less than KE, it means it is always better to give 100% in form of dividend, then the share price will be maximum. Now let's see. What is P0? Current price of the share. D divided by KE. D in our example is, what we have said is, earning per share is 20 rupees and the required rate of return is 15% and the return on investment is 10% and dividend payout ratio is 40%. It means whatever the company earns, it gives 40% in form of dividend. What is earning per share? 20 rupees. So 40% of 20 comes to be 8 rupees. That is, dividend each year will be rupees 8. Right? So 8 rupees divided by D divided by KE. Required rate of return is 15%. So 8 divided by 0.5 plus R divided by KE. R over KE. R is required rate of return is 10%. Cost of equity means required rate of, R is your return on investment. So R is return on investment, which is 10%. So 0.10 divided by 0.15, which is the required rate of return. Right? So R divided by KE. R is nothing but, let me repeat, the return on investment, that whatever the money company has, when it invests, it earns 10% of it. That is called R. K is return on investment or required rate of return of shareholders, which is 15%. So 0.10 divided by 0.15 into earning per share minus D. So earning per share is 20 rupees, dividend is 8 rupees. So 20 minus 8 whole divided by, this divided by 15%. That is 0.15, which is your required rate of return, KE. This comes to be 8 plus 8 divided by 0.15. That comes to be 106.67. Right? So share price will be, if the retention ratio is 60%, that is 40% is being paid in form of dividend, so the share price will be 106 rupees 67 paise. Here, since R is less than KE, the value of the share can be maximized by 100% payout ratio. Right? Here in this example which you have taken is that we have not taken 100% payout ratio, we have taken only 40% payout ratio. Let's see if the 100% payout ratio is, then in that case what will be the value of the share. As in this figure we said, if R is less than KE, then 100% payout ratio is the best way to increase the valuation of the share. Right? So let's see that if 100% payout ratio is there. Again we'll use the same formula, right? D over KE, 20 rupees divided by E is earning per share divided by 15% required rate of return plus 0.10 divided by 0.15, so your rate of return on investment divided by required rate of return into 20 minus 20, right? Because your dividend income earning per share is 20 rupees and you are paying 100% of it as form dividend divided by 0.15. That comes to be 20 divided by 0.15 is equal to 133 rupees 33 paisa. So what you are seeing here is that in the Walter model, Walter had tried to show that if R is less than the KE, in that case it is advisable for the companies to give more and more dividend, right? 100% of it should be, well, other things remaining constant. I am presuming other things are not changing, only we are talking of only that what will be the effect of the share if the payout ratio is a particular percentage, right? When the payout ratio was 40%, the value of the share was 106 rupees 67 paisa. And if the value of the share is, if the payout ratio is 100%, this I am presuming that when R is less than KE. Had R is greater than KE, supposing your required rate of return is 20%, and if company is earning, KE is 20%, and if your company is earning 25% on its investment, in that case, if zero dividend is being paid, then the share price will be maximum. But here in the example which we took, right, here R is less than KE. So what you're noticing is when company pays 100% of its earning, then the price has increased. 133 rupees 33 paisa. Right? So this is about your Walters model. The other method of calculating or finding out the valuation of share is called PE ratio, price earning ratio. This PE ratio does not give you exact idea. This is a broad idea, I would say, which tells you broadly about the valuation of the share. By this, using PE ratio, you cannot find out exact value of the share, but broadly you can find out that whether the share price is undervalued or share price is overvalued. Let's understand what is PE ratio means, price earning ratio means, right? So it is the most common earning valuation model. It is the ratio between market price of share and earning per share of a firm. Friends, practically I tell you, it is most widely being used ratio for finding out the value of the share. Means as a layman, if anybody wants to know that is the price of the share is overvalued in the market or undervalued, I would say the very first thing or amongst the first things which he sees is that what is the PE ratio of the company, right? How many times the price of the share is that of its earning. That is, PE ratio denotes how many times the price of the share is that of its earning. Say for example, if the earning per share is 10 rupees, right, and the price of the share is 100 rupees, I will say PE ratio is 10 times. Friends, I am repeating. I am saying earning per share is 10 rupees and current price of the share is 100 rupees. So 100 divided by EPS, that comes to be 100 divided by 10 comes to be 10 times. So P ratio is 10 times. Supposing current market price of the share is 150 rupees and the earning per share is 10 rupees, I will say P ratio is 15 times. So how I will judge? The question is how I will judge whether the price is overpriced or underpriced. This is the subject of discussion. So it is the ratio between market price of share and earning per share of the firm. I have already explained. P ratio measures how many times the investor value earning as reflected in the market price of the share. So valuation of share can be ascertained as value is equal to EPS multiplied by PE ratio, right? What is the earning of the share multiplied by P ratio? That is the value of the share. Now there are different approaches to determine the expected PE ratio. What is the right PE ratio for a company? Friends, practically speaking, I tell you, it's very difficult to tell that what is the right PE ratio for a company. How many times the price of the share should be of its earning. It's difficult to ascertain. But if we generalize it, we can say there are different approaches. Average PE ratio. Average PE ratio means in this approach, average PE ratio of the company is calculated by using historical PE ratio. So the company is in existence for the last 30 years. In the last 30 years, what has been the average PE ratio of the company, right? That you find out that what is the average PE ratio. I say company share on an average always commands 25 times of its earning. If its share is earning per share on an average of the last 25 years is 10 rupees means, and if the PE ratio is 25 times, I would say on an average the share should value at 250 rupees because PE ratio of this company is 25 times. Supposing earning in a particular year is say 20 rupees and historical PE, average PE ratio is 25 times. So I will say 25 multiplied by 20, that comes to be 500 rupees. The share should value as 500 rupees. The fair value of the share will be 500 rupees. So this is average PE ratio. Average PE ratio, you calculate what has been the on an average historically PE ratio of the company. So other determinants like growth in earnings, risk, dividend policy, etc. are the factors affecting PE ratio of the company. Friends, what is the right PE ratio? At what price earning ratio the share should value? It depends on various things. I would say it depends on industry to industry. Let me take you an example. Like for example, steel industry or utilities. Utilities company like which are in the power generating business. I mean companies which are in the power distribution business, gas distribution business, like companies like Gas Authority of India Limited, IGL, I mean Power Grid. There are many PSU companies which are in the power production or power distribution, NTPC, which are in the power distribution and power. These type of companies do not earn abnormal profits. They are public utilities companies. They earn normal profits. So these type of companies do not command normally. I'm generalizing it. In a country like India, where the prices are regulated by the government, right? So these companies do not earn abnormal PE ratio. They don't earn very high PE ratio. On the other end, the companies which are in the IT services, company like TCS, SCL, Infosys, Wipro, right? These are in the IT services. They command higher P ratio in the market because they are growing at a faster rate as compared to the public utility companies, right? I mean, there are certain companies which are commodity companies like steel industry, sugar industry, textile, sugar industry, cement industry. They are called commodities. There the income fluctuates very often. The price of the cement depends on the price of the international market. The price of steel depends on the price in the international market. So there are ups and downs takes place. So these type of companies which are in this commodity industry, they do not command very high P ratio. They command normal P ratio. The point I'm making is that there are many determinants of determining the right P ratio of the company. There are certain companies which are very fast growing companies. Like if I take the example of banks, within banks there are certain private sector banks which are going at a very fast rate. I am not naming the bank. Suppose there are banks which are growing 20%, 25% year after year. So these type of banks which are growing at a faster rate, especially I am talking of some private sector banks, right? The top notch private sector banks, they are growing over the last 10 years, 15 years, 20 years, they are growing at a faster rate as compared to some other banks. So these banks command higher P ratio in the company because their growth rate is high. There are certain companies like MNC companies, multinational companies. These MNC companies are very liberal dividend payout ratio. They give most of their income, or we say large part of their income in form of dividend. So such companies which give very liberal dividend, they command normally in the market high P ratio. Means over a period of time, if you observe their 25, 30 year, 40 year, 50 year record, you will find that these companies which are high dividend payout masters, which we call it the good liberal dividend payout policy they follow, they command high P ratio. So there are many determinants of the P ratio, right? So P ratio, as I said earlier, depends on the earning per share. I have already explained what is EPS. EPS is profit after tax minus preferred dividend divided by number of shares, right? So what has been the average PE ratio of the company, and on the basis of that you can find out that what is the current price of the share, whether the price of the share is undervalued or overvalued. To keep the thing simple, let me say, suppose on an average a company enjoys 20%, 20 times PE ratio, right? If you see the past 10 years record of the company, you will find that on an average the company share price fetches 20 times. P ratio is 20 times. We call it 20. So if the earning per share is 10 rupees, it means the fair value of the share should be 200 rupees. If the current price in the market is more than 200 rupees, it means share is overvalued. If the current price of the share is less than 200 rupees, I would say equity share is undervalued, because I am presuming that the PE ratio is 20 times, the earning per share is 10 rupees, right? So 20 into 10, right? So that should be the fair value. So on the basis of this PE ratio, we can find out what is the fair value of the share. So with these words, friends, I have discussed two models. One is PE ratio, that is on the basis of PE, that what should be the fair value of the share. The other model is that on the basis of the future earnings of the company, we find out what should be the value of the share. Thank you very much.